whatever you want.
We can get started. So just everybody's, we consider it everyone's time.
Okay.
So I will start out. Good afternoon, everyone. My name is Borislava Karagurgieva, and I'm the co-chair of the Chicago Bulls Angels Chicago. Our club is an alumni-led organization of the Chicago Bulls, and we're part of the global Chicago Bulls Angels Network. Our mission is to connect fellow alumni from the Chicago Bulls and the broader University of Chicago alumni community around angel investing. On behalf of our board, Elizabeth Bleakley, Greg Thomas, Tom Wells, Anju Rai Marchand, and Amalesh Sanko, I welcome you all today to this webinar. Special thanks to the Chicago Bulls Alumni Relations Office for helping us organize this event. Before we start today, there are a couple of housekeeping items that I would like to share with you. There will be two speakers today. You will hear my voice and our guest. All other participants will be muted. However, we would like you to participate by asking questions. And to do that, please type in a question in the Q&A box at the bottom of your screen anytime during the talk, or raise your hand and we'll unmute you. If you have any issues with audio, you may want to shut down any programs running in the background or dial in from your phone. Our presentation will last for 60 minutes today. This webinar is being recorded. We know you have a lot of challenges and demands for your time and attention right now, and we appreciate your interest very much. We are delighted to have Professor Meadows speak about angel investing in times of COVID today. Professor Meadow is a clinical professor of entrepreneurship at Chicago Bulls since 2000. He was awarded the 2002, 2003, 2004, and 2005 Phoenix Prize and the Faculty Excellence Award in 2010. He was designated twice by Businessweek as one of the outstanding entrepreneurial professors in the country. Professor Meadow has taught 8,000 students at Chicago Bulls in entrepreneurial finance and private equity, commercializing innovation, which he created, the New Venture Challenge, and is the faculty advisor for the Venture Capital Investment Competition. Since 1982, Scott Meadow has been a principal investor in the private equity industry. He is the 2011 recipient of the Richard Daley Award, given for direct and extraordinary support in the state of Illinois by participating in or being an advocate for the venture capital and private equity industry. Scott has over 25 years experience as a general partner with 4 venture capital and private equity firms, including William Blair Venture Partners, the Frontenac Company, the Sprout Group, and most recently with the Edgewater Funds, where he remains a senior advisor. Over the course of his career, Scott has approved hundreds of equity financing, been active in fundraising, and has personally led, originated, or created more than 60 investments, including 24 healthcare services companies, over a dozen consumer services and retail companies, as well as companies enhanced by the internet. Scott has been recognized by Venture One as one of the outstanding healthcare investors in the industry and is a testifying expert witness. Professor Meadow earned his AB magna cum laude from Harvard College and his MBA from Harvard Business School. On behalf of the Chicago Bulls Angels Chicago and the Chicago Bulls Alumni Relations, Professor Meadow, welcome, and thank you all for being with us here today. Now I turn it over to Professor Meadow.
Hi, everybody. Welcome. Nice to see you all. I think my topic today is angel investing in the age of COVID. And I think the first thing that we need to understand is what an outside investor provides to an entrepreneur. And remember that an angel investor is really a second alternative for entrepreneurs after institutional investors. So let's first try to understand some of the benefits that are provided by an institutional investor. Number one, they try to make deploying capital in private equity projects more efficient. They try to limit, or there is a limited sort of joint development of a project's underlying profit formula. There needs to be sort of a systematic methodology for forecasting fixed and variable costs. There needs to be a series of milestones that are set up for the project. And there needs to be transparency in the company's forecasts. And there needs to be sort of analytical support for the long-term trajectory of the business. And when we say sort of long-term trajectory of the business, we're thinking about, sort of the term hockey stick projections. And, everybody thinks of hockey stick projections as being sort of a negative, but what early stage project would you want to invest in that did not have hockey stick projections? So what's important is not so much the hockey stick projections, but what's the foundation behind those projections. So those are the issues that an entrepreneur should be thinking about when he brings outside money into their company. And I think with that in mind, an angel investor really sort of needs to think about themselves as another version of an institutional investor with similar disciplines. But I think first of all, we should look at what an institutional investor is providing and how that's changed in the age of COVID. First of all, institutional investors have sort of a tendency to follow the stock market, meaning that if the stock market is down in a particular sector, they are going to pull back and not invest in that sector themselves. Generally, these institutional investors have basically 70% of their assets under management available to invest in new projects. So when we have a pandemic like we've had and downward pressure on pricing, it really becomes important how much money they have to provide at this particular point in time. So if a fund has $100 million under management and they've invested $60 million, they really only have $10 million to support the projects that they're involved with. So therefore, they have to triage their own portfolio, basically look at projects that they've been financing that have not been hitting milestones, and those projects that have been hitting milestones, and really decide what they're going to do about the projects that have not been performing in this time of sort of desperate money. In addition, it's also an opportunity. So they have to triage the companies that are in their competitors' portfolio, because their competitors may not be funding those projects, and they may have the opportunity to come in and support those projects. There would naturally be sort of a decline in valuation during a pandemic like this. My first down crisis was, I believe it was Black Friday, and there's been many others since then. And there's always generally a downward pressure in valuation when that happens. Just a little reminder that projects that venture capitalists and angels invest in kind of fall in three criteria. One is it's a startup, one is growth equity, and one is near liquidity. And I think it's worth it to sort of just review what those projects are like. So let's start with growth equity. A growth equity project is a project that has a management team that can take the project all the way to a liquidity event. It will also have several units or examples of the profit formula working successfully. And lastly, some kind of commercial event like a referenceable backlog or something like that that they can point to. So in that particular situation, a growth equity project has a rate of return of 40%. Why 40%? Because it is a project that does not have concept risk, but rather has execution risk. So why is this important? Because if a project is missing any of the elements that I mentioned as part of the growth equity project, a full management team, unit models that are working in commercial events, then it is a startup. And startups are riskier and they have a higher rate of return of, say, 50%. But at a time when valuations are pushing in a downward direction, then all of a sudden growth equity projects, which have a lower rate, a lower risk profile, become less expensive. And so institutional investors, where they may have decided to invest in a startup, now may decide to invest in a growth equity project because its price has been reduced. So those are some of the things that are going on with institutional investors. They're triaging their own portfolio. They're not investing probably in new projects, and they're looking at projects in other people's portfolio that may be later in the development process, but be priced at a much lower valuation because of the effects of the economy in general being compressed and the stock market in particular. So that's a little bit about the background of what's going on in the institutional market. It's much harder for a new company to raise money. It's much harder for a portfolio company to continue to get financing in the future. And so what does that mean? That means that there's a conservation of resources by institutional investors and more of a focus on their own projects, and less money out there for other emerging projects that might be taking place. So what do they go after normally? Private equity investors really only invest in novel sectors that they understand. So technology, media, telecom, healthcare, financial institutions. They invest in something where the idea is novel, where the entrepreneur has centrality, which means that entrepreneur has sort of strategic sector-specific knowledge and operational access. And those are the kinds of projects that they're looking at, and also the kinds of projects that, in my judgment, an angel should be looking at as well. There's angel investing has been exciting over the last couple of years because many times people confuse brains with a bull market. If you think that you're ultimately going to get out of the project because everything is going up, that's going to create, perhaps a much less disciplined approach when you're thinking as an angel about participating. So let's think about, what a typical angel might look like. Generally, it's been a very an angel has been a very successful professional who's made a lot of money or a fair amount of money in their mind and has decided that they wanted to participate in the growth of emerging businesses. It's not a process really of going out with your buddies to Las Vegas and going gambling. It's really more about an approach that is pretty disciplined if you're going to come out making money in general, and more importantly, in these specific times. So I guess what I would say about an angel and how an angel should act in this market is really no different than I would expect an institutional investor to act in this particular market. And by that I mean, I think first and foremost is the importance of sort of staying in your lane. If you're part of an angel network and you go and you're sitting with a whole bunch of other people and everybody's listening to what's going on, and the collective group decides that this is an interesting project and we should go forward, that's important, but what role can you play, particularly if there's problems with this project in the future? And so what I would suggest is what I suggest to my own MBA students that are interested in becoming an institutional investor, which is that if early stage investing is all about concept risk, okay, where should your money be? Should your money be in concept risk, or should your money be in execution risk? Okay. And the way I would sort of think about that is, if you've got $100,000 that you're planning on investing in angel activities, it might make sense to put 20% of that money in at the concept risk stage. And let's just review what concept risk is at this point. The project does not have a complete management team that can take it to a liquidity event. It does not have the profit formula figured out and does not have that profit formula actualized in the marketplace. And it doesn't really have any kind of commercial event that has taken place in the life of that company. So that, when you think about it, is a relatively risky proposition. And so if you think about putting, let's say, $20,000 of that 100,000 into that particular project, and then using the remaining $80,000 or 80% to invest in the company once it's moved from an early stage project where concept risk is the thing that we're concerned about, to a growth equity project where we're concerned about execution risk. And one of the challenges with angel investing is the angels getting ahead of their skis, putting too much money into a project up front, and then that project ends up having a problem, and there's nobody to bail out that project, and that's a significant problem. Now, it's a benefit in the age of COVID, because if a number of projects have been triaged and are out there, and there's no institutional money to support those projects, those may very well be projects that are growth equity projects with institutional backing that have been left to fend for themselves, and angels may be able to come in and invest in those projects at a stage of development that's much later than an early stage project. So with that in mind, the notion of investing a 20% of your available funds into the early stage frees up the bulk of the money to go in at a time that's much safer. So you may be forfeiting making 10 times your money, but for the opportunity of investing more money at the execution risk side, which may allow you to make 4 times your money on all the money that's invested. But it's very important that you select a couple of different areas that you're going to be knowledgeable about. So as an angel, you sort of have a professional responsibility to fulfill the role that an institutional investor is going to provide. And private equity investors select investments where they have sort of unique skills and contacts that can enhance the success of the project. And though that's the same advice that I would give to angels, particularly in a post-pandemic world. So how do these private equity investors and angel investors potentially add value? Well, they help recruit executives. They provide access to potential investors that and also acquirers. So they may be knowledgeable about the people that can take us out at the back end of the project. They are likely to have a connection through their centrality to reach out to potential customers and make those kind of valuable introductions that could help a company get a first customer, which ultimately becomes a reference account for all new customers that are likely to work with the venture in question. They need to be able to provide some coaching to the senior manager. So you can't sit back in the bleacher seats and kind of watch the game play out in front of you. You have to be able to have the skill set so that you can influence the results and hopefully encourage senior management to make the right decision. You have to have some kind of industry experience, expertise, and some kind of strategic perspective. And those things will help edit the business when the company inevitably makes mistakes. I mean, one thing that we absolutely know is that every company we're going to participate in is going to make mistakes. We need to help by having a knowledgeable base to help edit that business model as it unfolds. So investors can really only add value to a project if they understand the economics and the profit formula, and if they trust the centrality of the entrepreneur. And if those things are not in place, then they need to figure out how to surround the entrepreneur with the kinds of resources necessary so that they can be successful. So, as you know, there's been a lot of changes and structures in investing in um, a venture capital project if you're an angel, okay? And generally, we've heard notions about safes as an example of how to structure your investment. And I think the issue you really have to think about are you as an angel being rewarded for the risk that you're taking? And let me tell you what I'm thinking about here. So let's forget any of the structuring facilities that are out there at the moment. But let's just say we invested as an angel into a project, and it's in the form of exchangeable debt, okay? And so what this would be is we would put a certain amount of money in, and at some point in the future, when an institutional investor feels as though it's appropriate for them to come in and invest in the project, they're going to go about the process of valuing the venture at what is an institutional round. Now, one can argue they are early stage investors, and that's absolutely true. They are early stage investors, but they're certainly not earlier stage than the angel investors who had been there in the beginning. So if the angel investor was to exchange their security for the security that the institutional venture investor bought when they invested in the company, it seems only appropriate that the conversion price that the angel is going to reap should reflect the risk of investing at a very early stage. And I think one could certainly say that investing at that very early stage should provide that early stage money with a 50% rate of return, because you're certainly investing in an early stage project when you come in before institutional money comes in. But when you think of safes now, oftentimes that reduction in conversion price is more in the 15, 20%, 25% sort of range. So it's very important that when you're investing in a post-COVID, post-pandemic kind of environment, recognize the risk that you're likely to take and make sure you're getting paid for it. And a 20% premium over an institutional investor's pricing, in my mind, has never been adequate in the past, and probably is certainly not appropriate in a post-pandemic kind of economy. I think the most important thing is to think about, okay, how can I intelligently and rationally be an angel investor? And what I think about is, if I'm an orthopedic surgeon and I've had a successful practice, and I now am deciding that I'm going to invest as an angel investor, I mean, what do I know? I mean, I've been to medical school. I've been in the operating room in major acute care facilities. I've been in rehab facilities. I've prescribed medication for both pain and for healing. And from my point of view, and I've run a physician practice along the way, either as a member of that practice or as the overseer of that practice if I'm in a small practice. So what I'm hoping you're beginning to see is that if I'm that orthopedic surgeon and I want to participate as an angel, then probably what I should be focusing on is healthcare services, consumer-facing healthcare information technology, and some medical devices as they apply to orthopedic surgery. And why? Because I know something about that. In addition to me knowing something about that, I also have a series of medical school colleagues and colleagues at the hospital and colleagues in the practice and colleagues at skilled nursing facilities and colleagues at rehab institutions, all of whom can provide me with the kind of expert due diligence capability to help me make a rational decision about the project that I'm thinking of investing in. So, I mean, if you think about how an institutional investing firm is set up, they may have 3 practice groups. They may be a healthcare services company that focuses on acute care hospitals, skilled nursing facilities, and rehab facilities. And that's all they invest in because that's what they're expert in. That's an area where they can help the company recruit executives. They can help the company put the appropriate board together. They can provide access to potential investors who, like them, are knowledgeable about healthcare services. They've been investing in the industry for years and years and years, and so therefore they have access to major hospital systems, major acute care hospitals, skilled nursing hospitals, and other sort of long-term care facilities that are important. They know people that potentially could serve on the board and coach senior managers, and they have industry expertise and strategic perspective. So I guess most importantly, be a rational angel. This isn't a blood sport where it's your blood that's being lost. This is a sport that you can manage if you rationally pursue areas that you know something about. Stay in your own lane. Make sure that in a post-pandemic environment, you realize that your money may be the money that may be the only money that's available, and so therefore you should be paid for taking the risk that you're assuming when you invest in a project that's likely to have a much longer period of time prior to getting institutional funding. And plan for that eventuality. If you have $100,000 to invest in this particular project, make sure that you don't put more than 20 or 25% into that project in the first round, and keep dry powder to support that project, assuming that you and your co-investors are the only investors that are going to be available to support that company through its life as a private enterprise. And then go back and look at the structure of investments that are being set up at this particular point in time. Does the SAFE structure make sense post-pandemic? Well, it could if the conversion price that you're getting on your investment reflects the risk that you're taking when you put money into the company. And it also should take into account the fact that you're assuming that that amount of money that's raised as part of the sort of, shall we say, first angel round of this investment takes the business from where it is today through the proof of concept phase. So you want to make sure that you're investing with a group of angels who share your knowledge base, who are also in your lane, and who have put in enough money to allow the enterprise that you're investing in to go from A to a discernible B, where a discernible B generates proof of concept, and that your investing syndicate of like-minded people have enough money not only to fund that proof of concept stage, but also enough money to fund the company till there's a potential investment by an institutional investor, or better yet, until there's an opportunity for a liquidity event to take place. So it's really important in a post-pandemic economy to avoid groupthink and to make sure that you're not looking at your angel investing as a social activity, but rather as an extension of the areas that you've built up expertise in over your time becoming a successful professional in whatever your line of work is. So I think with that, I see that we're at almost 5:45. Maybe at this point, Borislav, it would make sense to open it up for some questions. Does that
Sure,
make
and
sense?
yes, and we already did receive some. So, Professor Meadow, thank you very much. This was very, very interesting. My first question actually is, has the COVID-19, the whole pandemic situation, changed the probability of success or failure for startups? In terms of it's a sort of a cataclysmic event where, you know, it's more of a signaling. Would good startups be confident enough to raise enough money from angel investors, or what would we or would we have a lemon problem, you know, with the any company trying to raise right now? What are your thoughts on that in terms of?
Well, I think what's most important is that there's a race to cash flow positive, right? So there's an awful lot of projects that we're going to be looking at that make a lot of sense, but they may not survive the pandemic unless we take a very disciplined approach about the cost structure of the business, particularly something that may be pre-revenue or maybe therefore pre-proof of concept. So in that particular situation, it's important to make sure that there's multiple angel investors in the syndicate, so that there's plenty of money from each one of the members of the syndicate to support the enterprise as long as it takes this economy to come back. I happen to think that once the COVID pandemic is either brought under control through a therapeutic or a series of therapeutics or through a pandemic, I think we're going to see the economy, you know, come back faster. So you want to put yourself in the best possible position for that to happen. That means pushing the entrepreneur to get their burn rate as low as possible and hopefully get to cash flow positive as fast as possible, and to recruit a larger syndicate of potential angel investors to go in at this point in time, so that you have more money to support the company, and more pockets to support the company now, and more connections and a broader network to support the company now. But more importantly, we have no idea when we're likely to come out of this, okay? And given that, is there enough money among the syndicate of angels to support this company for, let's say, 18 months? And that's a combination of a large syndicate and really thoughtfully putting pressure on the entrepreneur to rationalize the microeconomics of their business at this point in time. Does that make
Thank
sense?
you. Yeah, that's we have another question. So for a new angel investor, somebody who is just starting out, what's the best place to look for investment opportunities? That's the question.
Well, I think it's good to invest with people that have similar backgrounds to you. I mean, Hyde Park, the Chicago Booth Angel Network, the Alumni Angel Network, that's where you want to be. If there's a particular angel network that happens to be, in the case of my orthopedic surgeon, nothing but a series of doctors investing, that would make a lot of sense. You want to treat yourself like you're an institutional investor. And when I was an institutional investor, I always invested in early stage projects of syndicates of 2 or 3 institutional investors who I had invested with before, who I had trusted their perspective on this particular sub-segment of my expertise. I knew that they had contacts that would complement my own contacts, and I knew that they had enough money to support the company on a pro rata basis as the company went forward, if our group was the only money that was going to be available to that company over the next 18 months. And then if we're surprised and the economy turns around and all of a sudden we have institutional investors coming to the forefront, then we can participate in that institutional round alongside those institutional investors. So we win, hopefully in either case in that situation.
Thank you. One question that frequently comes up is financing vehicles for angel investing. For example, safes. What would you recommend? What books would you recommend or other resources for relevant information on vehicles, ways of starting sort of to angel invest?
Well, I don't. I think it's a hard question to give an answer to, because there isn't, the people that tend to write books on this topic are not people that have actually been successful in the area, and so there's not a lot of books that I recommend to my students. That being said, I think that there's a lot of content that's being provided by Chicago Booth, and getting access to some of those classes, which are often made available, particularly during the time of the pandemic, and listening to how some of the professors at Booth think about things, is an important approach. I think a general understanding about safes and so forth can be dragged down from the internet. But the important thing that you've got to keep in mind about financing vehicles in this arena is that they generally, one way or the other, are set up so that money is invested, but ultimately pricing is put off until there's an institutional round. And then when that institutional round is established, then there's a reduction in the conversion price that the angel investor uh, gets from participating at a much riskier stage of the company's development. And the question that I think one really has to think about is a 20% reduction in a post-pandemic economy reflect the risk return that an angel should be receiving at this particular point in time? In my way of thinking, it's not enough of a reduction in exchange rate. It should be a larger number than 20%, certainly 30, 40, 50%, because there's not, the institutional investors are going to be a little shyer about stepping in and participating, funding projects at this point in time.
Thank you. One question that is about timeline in terms of what is the time expectation to stay within an investment in terms of monitoring, watching, sort of being invested in that investment. How long would a person, you said longer time period so the startup can get out of that situation, but in terms of number of years, what is your guide sort of thinking about that?
Let's think about if you and I, Borislava, were making an investment and we were at an institutional, venture capital fund, and in that particular, I want to make sure I got your question, Borislava. Ask it to me again, please.
The question is about time expectation of being an angel for an investment.
Okay.
After making the investment, how long does it take to monitor and exit, basically?
So for the project that Borislava and I are going to invest in, and we're institutional investors, we're partners at Venrock. And so one of the people that's very important to our investment decision, because normally we're going to be investing in early stage projects, okay, is that this project is in fact disruptive, okay? And interestingly, a research analyst at a place like JP Morgan is going to be a sector specific expert in this particular area that Borislava and I are thinking of investing in. And we're likely going to talk to that research analyst about the reasons why the project that we're considering is in fact disruptive. And probably before we invest, we are going to have that research analyst shaking his head that yes, if those 5 or 6 different attributes are in fact present in the new venture, then it is in fact disruptive. And what's important about that conversation is that venture capital projects do not go public when they're cash flowing. They oftentimes go public when they've proven that in fact they are disruptive. That's why you see a number of projects going public that are not profitable yet. Well, what I'm thinking about is that we're supplying enough money as an angel syndicate that we're able to speak for the financial support of that enterprise until we've been able to prove to the Wall Street analysts that in fact the project is disruptive. And the reason that that's significant is because that research analyst, once we've been able to show that, is probably going to be pretty interested in either introducing the project to the investment banking side of their house, either for an IPO or to potentially sell the business. So funding that proof of concept component is vital and making sure that you have enough money to get all the way to the end of that proof of concept story is really critical, because if the public market is not there, then your angel network has to be there to support the company until the public market or a potential merger and acquisitions partner emerges to take us out of the investment.
Thank you. One other question that I wanted to ask you is there is a notion that angel investing should be sort of looked at as a portfolio of investments, and where in a typical portfolio sense, we look at correlations and we look at how, risk and return. Investing in one industry that an angel investor knows, that's going to be hard to actually put low or negatively correlated investments within one portfolio, within one set of portfolio. How would you address that? What's the recommendation that you would give someone when putting together a portfolio of investments?
Well, I think I would think about it as I would adhere to the 5% rule, that I would never invest more than 5% of what I had to invest in any one company. That's number one. And so what does that mean? If we were big time angels and we had $100 million to invest, and there are some people that have done very well and have that amount of money, then that would mean that we wouldn't invest more than $5 million in any one investment. And what that means is, if you're following my modus operandi, that would be 1 million in the early stage, and then 4 million following on in the growth equity stage. So when I think of a portfolio of investments, I'm thinking of a portfolio of perhaps 10 different investments that I had, and all of those 10 investments in a sector that I understand. And when I say I understand, I mean somewhere in my education, I have touched this marketplace, and I have a network of people that can help me with the due diligence process before I decide to go in, and a network of people that can help me monitor the project as I move forward, and can potentially help me get out of the project when it's time to exit. And that would be the way I would look at it. I think that if you go into a project, and if you go into angel investing and the notion is that you're going to invest in one project, that's a pretty scary proposition. I think 5 projects to 10 projects makes sense, but much more important than that is stay in your lane. Stay in what you know. This is not a weekend in Las Vegas. This is your money and your family's money. And stay in your lane.
Thank you. Well, I guess it's almost 6 o'clock. We have one, I hope you have time for one more question that we received. If your son or daughter told you they were thinking of becoming an angel investor, what would you tell them?
I would say, congratulations. That's fantastic. You've made so much money in your life that you're able to invest in early stage venture projects, which are really risky. So I'm so proud of you that you were such a successful screenwriter or such a successful lawyer or such a successful entrepreneur that you made so much money selling your company that now you're going to invest as an angel. That's fantastic. Just do me one favor. Only invest in the things that you've been successful in the past. because you have the best chance of being successful in those things in the future.
Professor Meadow, thank you so much. This has been a very informative and enjoyable conversation with you. We thank you for your time. And this concludes our webinar for today.
Thank you, everybody. God bless and take good care.